You are now doing less with John and Jeff. Welcome back. This week, I think that it will be nice to take a break from talking about economics, take a break from talking about finance and the markets, just talk about something else for... Obviously, I'm just kidding. This has been the craziest week. This has been the craziest week yet since we've started recording this podcast. This is why we created a podcast, in my opinion, to talk about events like that occurred this past week. Off the bat, the emergency Federal Reserve meeting, an emergency Federal Reserve rate cut is, that we haven't seen in 10 years. So we'll talk about that. But yeah, we got a lot of juicy stuff to talk about, and and I hope the followers are ready for it. Hopefully you guys are anticipating some good conversation. What do you think, Jeff?
Yeah, I think we might have to change the name of the podcast to Do More, though, because you started taking notes for the podcast, and I can't in good confidence keep the name Do Less while you're doing all this prep work.
This actually isn't the first time I've jotted down some notes to talk about, but
let's start calling it Do Less with Jeff and Do More with John.
Okay. All right. I see how it is. Now I'm looking at my notes. I have 2 notes. So
it's too many.
My 2 notes so far is Fed wants you in stocks was my one note to talk about.
Fed wants you.
Yes. And then lowest 10-year yield ever were my 2 notes that I was going to write more, but I never got to it. So let's start off with, let's actually go in reverse order. So the 10-year yield, it's actually the whole yield curve, really. So just real quick, in the past week, maybe a little bit more than a week, but bonds have been going way down in yield, which means their price has been going way up. There's massive amounts of money going into bonds. I think that should be partly the focus of this episode. Just talk about the bubble in bonds, how much bond prices are inflated with artificial demand and excess money pouring into bonds. But as mentioned in the note, the 10-year yield closed the day. Today we were recording March 5th, 2020. The 10-year yield closed at a 0.915%. That's the lowest close ever, if I'm not mistaken. But that's not to mention, this is actually recording this a little after 9 p.m. The 10-year Treasury note has proceeded to fall at an additional 0.07% to be at 0.84%. So this is the lowest yield on the 10-year Treasury note that has ever been offered, at least in the last 100. Well, yeah, I think it's safe to say this is the lowest ever. Yeah, even in like after the Great Depression, you could still get like a 2% yield on the 10-year. If you lend your money to the government for 10 years, you say, here you go. Right now they are offering 0.84% on that money, which is crazy.
I mean, the government's offering more, but the price you have to buy it at, essentially the yield comes out to be 0.84%. Like the bond might say $100, right? And it might say, I don't know what it'll say on it, but it might say 1% on it. But the price of that bond has gone up to the point where it's like the bond now sells for a price such that 1% of the bond is now actually 0.84% of like the higher price. I don't know if I explained that well. Like the interest rate on the bond is not going to read 0.84 0.84 or whatever the market rate is, right? The interest rate on the bond is going to say like 2%. But the original price of the bond, or like the price of the bond is going to, like that you can buy it on the market for, is going to be higher than what's on the bond.
I see. Yeah, the secondary market
Right.
as opposed to the right. But this just the point of this is just goes to show how much of a demand there's been for bonds, which is supposed to be it's the safest asset. It's the risk-free yield, right?
Right.
So, as Neil Kashkari, he said this about a week ago. He said that low yields are a statement to how confident investors are in the economy, how comfortable they are with or how confident, I think is the word he said, which is just kind of absurd in my opinion. We don't have to get into that too much, but to say that bond yields go down because investors are confident is a little bit missing the point. Would you say?
I mean, I think it's just dumb. Like, if the investors are confident, why would they be investing in an asset that's relatively safe and has such low yields? Like, if you're confident, you're going to be investing in things that have really high yields and high risk because you're confident. What kind of confident person hides their money under a mattress? That's not a confident thing to do. Okay? It does mean they're confident in the U.S. government's ability to pay, but that's not what he said. So he's wrong. But I do think people are way overconfident in the U.S. government's financial health. To be lending your money to the U.S. government, earlier I made the distinction of that's not exactly what's going on, but like essentially you're lending your money to the U.S. government for 10 years to receive less than 1% interest each year, okay? And the U.S. Treasury report, like the fiscal report for each year, has stated that the U.S. Treasury is on an unsustainable fiscal path. It's straight from the horse's mouth. They say this is unsustainable. We cannot sustain this. And nothing has been done. There's no plan in effect to change that. There's nothing that would suggest we're going to veer from this path anytime soon. And yet still, people are making 10-year loans at the lowest rates in history. So that doesn't make any sense. But it starts to make sense when you realize this isn't a free market and the Federal Reserve is manipulating this market. And so and it's not even just the Federal Reserve. It's like the central banks across the entire world are suppressing interest rates across the entire world. Like in Europe, bonds are already negative. So like they're ahead of us as far as the degeneracy game goes.
The degeneracy game. Yeah, in Europe they're really confident. In their, but yeah, I thought you were gonna say, and this is something you've said to me before, or it's something. I mean, we've talked about. A lot of people talk about, I think, but this fall in yields of bonds so far below the inflation target is just it speaks so loudly to the fact that people don't think that there will be inflation, or that when people are predicting, less demand, then you can predict like less inflation. So people think that there's going to be like this kind of recessionary, like a recession. In a recession, there can be like deflationary forces. So if you're fearing a recession and you think inflation is going to be super low, then you may be willing to have your money in a very low yielding asset. But this comment that investor confidence is what's driving yields down. Well, it's like if investors are confident, then aren't you saying that they're confident that there's going to be inflationary forces? That's just
It just doesn't make any sense.
it's like an oxymoron. Yeah.
Like confident in what?
Right.
Like the only thing that it could be confident in is the financial health of the U.S. government, and that's, like I said, not a good idea either.
Yeah.
But it's, I think what really they're confident in is that the Fed will cut rates. They're really just playing the Fed. So like if you buy bonds, right? And then the Fed changes, they cut interest rates. Well, then the next round of bonds are going to have lower yields by default on them. So your bonds that you're holding are going to go up in price to match them. So you're essentially, what people are doing is they're not holding these bonds to maturity. They're not buying a 10-year bond and sitting on it for 10 years. What they're doing is they're buying the 10-year bond. They're expecting interest rates to go lower, and then the price of the bond goes up, and then they sell it. So it's not like it's not like they actually want the bond. They're just speculating that the bond is going to go up in price. And so far that's been true. But what happens when that's not? Like there's a limit to how low yields can go, and people will still buy them. I don't know where it is, but it exists. And sooner or later we'll hit that. And there's a long way to go back down if we do.
Yeah. Yeah, you could say like a 0.8, whatever I said, 0.86% yielding bond. It could seem a little bit absurd. But to think that would go down even further, okay, it's risky. Then it's a 0% yielding bond. Okay, that's that's crazy talk. You're literally not doing anything with your money. You're just transferring certain claims for other claims. Like you're not doing anything.
Right.
It's just like, it can go down further. Okay, it happened in Europe. Okay, fine. So let's say it goes down to negative 1%. It's just like, how can you even wrap your head around that? That just doesn't make any sense. You can try to explain. I've seen people try to explain it. Doesn't make any sense.
Yeah.
Why you would want less money tomorrow than you have today, and then say, it'll go down even more than that. It'll go down to -3. It's just like, at that point, there's no explaining it. People are gonna say this is absolutely. I'm not saying -3 is the point. I'm saying It should be any point along those lines. It's just people kicking the can down the road and saying, someone else will buy it for a little bit lower. People will still try to explain. It's just like, it's already at a point where it's the Fed is already targeting an inflation that's neutralizing and negating these bond offerings.
Right. Like, the Fed's inflation target is 2%. So you're literally losing your money if you buy these things on paper.
Yeah, it's already negative. These yields are already negative in real terms. So talking about so it's just pretty crazy. It's just a crazy phenomenon. So let's start talking about what is causing this phenomenon actually right now. I think it's certainly a flight to safety. So last episode we talked about the coronavirus, how it's starting to impact markets. The Bernie Sanders polling, how it's impacting markets, which at the time was high. He had a relatively high chance. He was over Biden at the time. Since that episode, it's actually flipped. Super Tuesday occurred. Biden is now ahead of Bernie Sanders. And so, put that aside for a second. But the coronavirus is an existential threat to economic forces, societal forces, communities, businesses will see this virus and it'll be devastating to businesses and financial systems. So there's this the flight to safety, flight out of risky assets, stocks, into bonds, which are the safer assets, which is kind of just like almost like an algorithmic dumb button you push. It's like if I see the current situation is good and will continue to be good, press buy stocks. Just press that button and sell bonds or whatever. If I think that it's going to be risky, I think that certain financial processes, establishments, I don't know what you want to call them, but if I think that there's any risk to that process, you hit the other button, which is sell stocks and buy bonds. So I think a lot of the other button has been hit in the last week to see these yields. I mean, the yield on the 10-year, I have that number a year ago, right, was
800%.
2.691%. So that's a year ago. So it's gone down, and like I said, it's all-time low. The whole yield curve, the 2-year note, the 10-year note, the 30-year note. 30-year note is 1.5%. They're all just absurdly low, all-time lows. So it's just investors are not, I don't think that there's a lot of logic. Like, we're trying to explain the logical aspect of buying a 10-year treasury note that yields 0.84%.
Like, you might as well just hold cash. Like, what the heck? 0.84%? Why give someone your money for 10 years if they're going to give you 0.84% a year? Like, it's like nothing. It's just like, you might as well have the cash that you can, like, it's liquid. You can do whatever you want with it. It's like well, why not have that? Just makes no sense.
I heard a joke that's pretty, it kind of frames the irony of it. It says, in these times, you want to buy stocks for the dividend and you buy bonds for the appreciation.
Yeah, that's good. That's funny.
It's the exact opposite. You're buying stocks for the dividend yield on the S&P 500. I think right now is like 1.3.
Yeah, it's higher than than the bond yield,
it's like
which is
the
absurd.
whole bond curve is, the whole yield curve is below that. So it's like the safe asset is becoming,
dividends
by nature, like the risky,
right.
by nature, the riskier asset, which is stocks.
Well,
stocks.
I also think there's just like a ton of momentum behind, like you said, it's like this algorithm where it's like, oh, stocks bad, buy bonds. It's like there's so much momentum behind that idea. And for a long enough time period, bonds were trading in a range where that was not an unreasonable thing to do. But like, essentially one of the assumptions in that algorithm where it's like stocks bad, buy bonds, is that bonds are a good enough investment.
Mm-hmm.
But it's like that algorithm fundamentally breaks if the bonds are no longer intrinsically a good investment. And they're no longer intrinsically a good investment. It's pure speculation at this point that you'll be able to get a return on these things, because on paper, the thing is losing you money.
Right. So let's start talking about stocks. So stocks, we mentioned, as of last podcast, they were down like 12% on the week. The weekly loss was like 12%. That's when we were talking about the causes of that drop. We attributed to the coronavirus, which we said certainly that's, you can almost definitely say that's at least one of the major factors for that sell-off. Sanders' rise in the polls. And then, so as of this week, so on Monday, the stock market was down. Oh, I'm sorry. I'll delete that. All right. So as of this week, on Monday, right? Monday comes and there's a 5% up day. So half of the losses basically are regained. Now, what was the cause of this? So this is what are the causes? So if you're reading on Twitter, people are trying to attribute this to everything. I mean, some people attribute it to, Biden was going down in the polls. Some people are saying, the coronavirus isn't that much of a threat. There's a whole,
I mean,
everybody that's got a opinions putting their opinion out there onto Twitter.
And I don't know. I feel like very often it's not even what the headline says. Like, you might think it is, but a lot of people don't necessarily pay attention to the global money supply and what's going on in the repo market and things like that.
Right.
Like, there's probably a lot of stuff that institutional people are paying close attention to and their algorithms follow that not necessarily the headlines are paying attention to. And so, when we say, the market dropped because it was scared of coronavirus, it's maybe, but maybe that's not why.
Right.
You know what I mean?
I couldn't agree more. I always liken it to if you're reading a book and you have someone sit next to you telling you why the author wrote every sentence as you read it. It's you read a sentence and then they tell you, the author did that. The author said that because they want to set something up for later. And it's did you read this book before? No, I've never read it. It's do you know how it ends? No, I don't know how it ends. It's just okay, well, how do you know? It's well, I agree that you could draw that conclusion from reading that sentence in chapter 1. But trying to attribute the author's intentions after reading a single sentence in the first chapter, it's you got to read the whole book before. That's why oftentimes the hindsight is actually the really important. So paying too much attention to these economic journalists, financial pundits, I think they get a lot wrong. Yeah, hindsight is often what you should pay attention to in the markets and not really paying attention to the up to the minute. It's literally up to the minute.
Yeah, I mean, it's just when people say, that day, this is what happened, it's they don't know that.
You don't know. You don't know.
The past week, you can be pretty confident coronavirus had something to do with it because it's affected global demand pretty significantly, especially for oil, which is a big deal. But it's day to day, it's so hard to just be this is why. Because even if just a big, if Google just had a really good earnings report, that can move the market, So it's that's just one factor, and it could be completely separate to everything else. Or if Google had a really bad earnings day, things like that. It's
right.
These things move markets, or just all sorts of stuff. It's so many variables that it's just picking one and being this is why the market did what it did. It's well, there's actually 10,000 more variables that you probably should consider as well. So it's,
Yeah. All right. Now I'm going to predict why the market moved the way it did on Monday. Or not predict, explain. Because I do think I was pretty confident. I saw something. I follow a guy named Jim Bianco who tweeted something. And this is actually what I texted you, Jeff. It was Sunday night. He tweeted something that no one else is tweeting. He was watching the futures markets for the Fed funds rate.
Right.
And he said there was a big move in the futures markets. Investors are predicting a 50 basis point cut by tomorrow morning, by Monday morning. This is really substantial because the next meeting isn't until 3 weeks.
Right.
This is calling for an emergency rate cut. And he tweeted this Sunday night. And I said, emergency rate cut, that is that's unheard of outside of a crisis.
Right.
So this is something for him to tweet that, that's definitely something to watch. So, and I looked at the futures markets, and sure enough, investors were really pricing in an emergency rate cut Monday morning. Well, Monday morning comes, no cut, right? And I'm thinking, wow, what are investors going to do? Are they going to, flee without this consolation?
Someone in the Fed spilled the beans.
Either that, or yeah, it's very likely that, or I have a theory that just like investors know, they know that the Fed is trying to front run. They're trying to front run. They're trying to front run any like big movements, and the market knows that. So if they start a big movement, then the Fed is going to have to capitulate. Like the
Yeah,
Fed
I
has
guess
already
it's like
capitulated to like the
if investors see enough of a drop, then they'll start to buy in anticipation of a rate cut. And so
exactly
like they're just anticipating that.
right. So if the futures for a rate cut increase, and the market increases on that futures increase, and when I say the market, I mean this like the stock market goes up, stocks go up. Then the Fed is going to see that, and they're going to say, well, we have to now cut rates, otherwise there's going to be a massive drop in the stock market.
Right.
So it's like the tail's wagging the dog.
Well, I think in this example, I wouldn't say one causes the other. I think this is an example of nonlinear causality, right? So it's like the Fed affects the market and the market affects the Fed. They both affect each other's decisions because they're just part of the same environment. And so like there's like a feedback loop there. And so it's like you can't really, it's like you can't attribute cause, right? Like you say, oh, the market caused the Fed to cut rates, but it's like, but the Fed cut rates because of the market. So it's, or wait, I said that wrong. But it's like, you could say the Fed or the market rallies when the Fed cuts rates, but it's like the market also caused the Fed to cut the rates. So the market caused its own rally in a sense. So it's like, there's just like, there's no way to like make sense of it.
Well, I would no. Well, so here's, I mean, you can bifurcate in this example because it was on the weekend. The markets were closed. Like, it was the weekend move that prompted the rally in the stock market. The weekend move in the futures market.
Yeah, but I don't think that's necessarily true though, because like the Fed saw the 10% drop over that week, and people knew whether or not they're trading, they still know the Fed's gonna do something. So it's like people see this move in the market and they're like, okay, the Fed's gonna do something. And so the Fed does, and then so the Fed does something. And so it's like they're both interacting with each other. You know what I'm saying?
And it wasn't just a 5% open, right?
Right.
Is what you're saying. It wasn't like as soon as the futures had settled on an emergency rate cut, the stock market moved in exactly a seesaw kind of thing. But it was, it was like slowly throughout the day, it was becoming more and more priced in that this emergency rate cut was going to come. And so, yeah, okay, that's fine. But if you watched the things that I was watching, the market was going up, which is typical of anticipating a rate cut. The dollar was going down, which rate cuts, similar effect, and gold was going up. So I think really the things that you would expect from a rate cut, you were seeing on Monday, as if it was a certainty that it was going to happen, and then there you have it. On Tuesday, it happened. The emergency rate cut did happen.
They panicked.
They panicked. They capitulated, whatever you want to call it. And the funny thing is, on the rate cut news, obviously there was a short spike, but then the market sold off. I think it was a matter of buying the rumor and selling the fact. Where, like I said, all of the investors that were recognizing that this consensus is now that there's going to be an emergency rate cut started to buy the market, and then when there actually was an emergency rate cut, all the people that bought up to that point realized how many new buyers there would be on this news.
Right.
Because that's what the news warrants. And they said, we've already bought the stock that we wanted to buy on this news.
Right.
So now we're going to sell it to the next guy to be the bag holder to make a quick profit. So that's how you get the buy the rumor, sell the fact kind of movements in the market. And the market was down 2.5%.
Something
or
like
3%
that
on Tuesday. And then Wednesday was back up 4%, and then today on Thursday it was down
like 4%. Yeah. So it's
So
moving a lot right now. It's like
it's moving a
crazy
lot.
volatility right now.
It's crazy. So the other thing, so we mentioned bonds, we mentioned stocks. I wanted to mention the dollar. The dollar's had 1 or 2 up days in the past 30 days. Like, I got to double check the numbers, but it's probably not 30 days, probably like 2-3 weeks. I think February 12th, it peaked at like 90. The DXY peaked at like 98 something. It's been down like every day since that, which in my opinion is the anticipation of like a quantitative easing event or like a massive money printing event.
I mean, like sooner or later, people are going to realize like the financial health of the U.S. economy, or not the U.S. economy, but the U.S. government is not sound. And in fact, the only thing keeping us from like insolvency is the Federal Reserve as the buyer of our bonds. And so like the amount of money printing that's going to have to happen to keep our government running, like we're going to start to see some serious inflation. Like if you look at Argentina, they're a lot more irresponsible than we are, but you know, like if you look at their financial health, it's not like leading up to this past year they had like in like 2019 they had an inflation rate of 60%. Okay, that's insane. You know, that's you're losing over half your money if you put it in the bank. So like that's some serious stuff going on. But like I'm not gonna say they're not more irresponsible than we are, but it's not like they're astronomically more irresponsible than we are. It's like, you know, they might be twice as irresponsible, but it's like that's not like like my point here is that level of inflation is not like an impossibility for us if we don't.
It's not a matter of it's not a matter of policy difference. It's a matter of scale difference, like a magnitude difference at this point.
Right.
We're doing what they're doing. We're just doing it at a small scale for now.
Right.
For now.
Yeah, for now. And so like I think they increased their money supply by like 300% or something crazy. But you know, we're doing like if we start doing quantitative easing, the same thing's going to happen to us. Like we're going to start increasing our money supply at those levels. We're already like the Fed is already doing that in terms of the repo market. They're printing like, you know, almost $80 billion a day or something crazy right now. It's like, it's a lot of money being printed and it's not enough. Like a lot of the bids in the repo market to the Fed are going unfilled. So they're like printing all this money and the repo market still wants more. So it's like, we're in a bit of a pickle here. And the fact that people expect inflation to remain low, I can't understand that opinion. I think part of it is like recessionary fears, right? So people go, oh, coronavirus, it drops oil demand, right? So that lower price of oil, you know, that causes deflation. That makes sense. But also the majority of the world's, you know, fossil fuel production, not necessarily just oil, but like natural gas, which is another big fossil fuel, actually comes from the United States now. It's called the shale region. It's like the Pennsylvania region of the U.S. And what they do is called fracking. You probably heard of fracking, but it's they essentially are pulling oil out of the ground through this like new technology called fracking, and it's a more expensive way to get oil. Like in Saudi Arabia, the oil just kind of flows out of the ground. Like you just dig a hole and the oil comes out. It's like much cheaper to get the oil. But when oil is, you know, $50, $60 a barrel, suddenly fracking becomes profitable. But if you have the coronavirus happening, which is dropping oil prices down to, you know, $40, suddenly these shale players are going to have to exit the game. That's going to drop production. And what happens when production drops? The price goes back up. So there is like a sort of floor to the price around $50. I know it's lower than that right now, but my point is it shouldn't last very long, because sooner or later people producing oil in the shale fields are going to have to drop out, and that's going to start sending the price back up. So there is a sort of floor to deflation, because yes, at first, if the supply lines are running like they're currently running and demand falls, then yes, prices drop. We know supply and demand. But supply soon enough will follow, right? If people are anticipating lower demand, they're going to close up shop. They're going to make layoffs. They're going to do what they need to do to prepare for the lack of demand. And so that's going to lower supply, and then prices are going to stay the same, if not even increase, especially in the face of all the money supply manipulations coming from central banks. So these really low inflation expectations, I think, are pretty not only misguided, but just incredibly risky to be betting on low inflation right now.
Right. Yeah, I would agree. I would say, the Federal Reserve, which is the main actor in inflation,
In the U.S.
wants higher inflation for the U.S. dollar.
Yeah.
Wants higher inflation.
Right.
And it's like everyone's anticipating, no, they can't do it. They can't.
They can't.
They won't be able to. It's like at a certain point, I think the reason, so people say, up to date, we haven't seen inflation, and they've done all this money printing, $4.5 trillion, I guess you could say, in total, most of which after the 2008 great financial crisis. How come there hasn't been rampant inflation? And some say that there has been. I would say that the price increase in the stock market over that time is stocks are something you can buy.
Mm-hmm.
Their prices have been going up, so that's kind of a signal of inflation. Inflation isn't always unilaterally applied to everything you can buy,
Right.
As some economists may assume in their models and in their ability to calculate a single number, as we've spoken to on previous podcasts. When you formulate a single number for inflation that assumes that dollars or the currency are the velocity in every single market that the currency is being used as a medium of exchange in is, remains the same over time, which is definitely not the case. It's like
Right.
one of the most absurd assumptions you can make in a market. The money that is printed, if that money is only given to a certain sector that's using that money to put into stocks, for example, then the velocity of money in the rest of the economy is unchanged, or maybe decreased almost, to maintain or have a kind of a low price increase in other sectors and other prices. So all I'm saying is, if there's like a shift in that allocation, if, for example, something like a universal basic income was applied, where the printed money goes directly into the pockets of Americans, maybe that money doesn't go into stocks. That money goes into bread or goes into bids up the price of a bus fare or a new car. So you could see that price inflation that has been contained in the stock market maybe leak out into the broad price system.
And I would argue, like many others, not mainstream people, but that actually the real definition of inflation, or what should be the real definition of inflation, is expansion of the money supply. Like, to me, at the heart of what inflation is, it's the expansion of the money supply. And the increases in prices tend to be downwind of that root cause. Like, to me, the people who look at just the general price level or whatever as the measure of inflation, I think they're looking downstream of the actual important thing, which is the change in the money supply. And so what the Federal Reserve does is they've significantly grown the money supply, And that in itself is inflation. And then what has the inflation done? Well, it's driven up increases in prices of the stock market, in bonds. It hasn't caused increases in the prices of like food and things like that. But that doesn't mean like, stockholders and bondholders just get like free money. That's not how it works, right? Essentially, the way you can think about it is, right? So by intervening in the money supply, what the Fed has done is they've lowered interest rates, and so the people who are saving and earning money through interest essentially are earning less than they otherwise would have, and the people who have their money in riskier stuff like stocks are earning more than they otherwise would have. So essentially, at the end of the day, all that's happened is a wealth transfer from generally what is the lower half of income earners to the upper half. And that's all they've been doing. And I think they're oblivious to this. I don't think they're intentionally doing that, but it's like, in effect, that's what they've done, is just a wealth transfer from the lower half of Americans to the upper half of Americans by doing what they're doing.
So you brought me to my other bullet point. The Fed wants you to buy stocks. The policies from the Fed, it's no longer ambiguous. Up to this point, you could say, oh, the Fed's actions have been driven by metrics from the economy, data from the economy. They want, this or that, unemployment to be higher or unemployment to be lower. They want businesses to have higher earnings, what have you. Mm-hmm. Right? You could make these arguments till you're blue in the face. This week, though, I'd say is a massive turning point in those arguments. This week, we've seen an emergency rate cut from the Fed with no economic data release. The only significant change is I wouldn't say the news about the coronavirus, which, I mean, people will point to as the reason. Even that was around for the 3-4 months.
Right.
So the coronavirus, I mean, I guess you could say the first 2 deaths, I think, of the coronavirus in the U.S., but that's not economic. That's not an economic indicator. The only other thing is the massive drop in the stock market. Mm-hmm. And so the Fed has acted to comfort the market and to help the stocks not go down, which is like what they say they don't do. But I think it's clear now. The debate is over. I think we can say the Fed wants the stock market to go up. They want you to buy stocks. They're okay with bond prices to go down, which makes stocks relatively more attractive. They want Americans to be in stocks, investing in stocks, buying stocks. They need it. They need it to keep going up, the stock market to keep going up.
Yeah, and I mean, I don't know if this is... I don't know why they're doing what they're doing. I don't know if they have some sort of strange rationalization for the whole thing, or they believe in the wealth effect is very important for spending and all that. I honestly can't speak to it, but it's like there's a chance that they realize that there's many institutions that essentially collapse when the stock market collapses. And we saw this in 2008. It's like we've basically made this upside down pyramid for a lot of things, that where the bottom of that upside down pyramid is like the stock market, right? Like everything else like rests on top of it. And so if the stock market collapses, other things start to collapse. And that's what happened to it's so like, I guess what could be one of their motivations is just to prevent like a financial crisis again. But I think it's futile. And you're really starting, I think we're really starting to see the effects of this bad policy taking shape. Like the amount of people that are just frustrated with, their standard of living, they feel like it just isn't increasing like as much as they feel it should. Like just there's so many people out there who feel like their lives are just not improving the way they used to. And they're right. And the reason for that, but they're all looking in the wrong place. It's like, they think Trump's going to help them. They think Bernie's going to help them. That's not like they can't do any, they have no tools to help these people. The reality is the Fed is transferring wealth from the average person to the wealthy. It's like there's always going to be inequality. Don't get me wrong. If we didn't have a Federal Reserve, there's still going to be inequality. But the Fed, that's not the point. Inequality is not the point. The problem is the wealth transfer. It's the fact that wealth is actually being siphoned from one group of people and going to another. Mm-hmm. That's the real problem here. And people, like, they can feel it, but they're not noticing who's doing it. And my point is, it's just going to get worse and worse as the Fed gets more and more irresponsible. Like, I think 2008 was like really a turning point in like public policy, just like the way people looked at politics. Like, it just really started to divide us, I think, after 2008. And it's just gotten worse and worse. And like, if the Fed does another round of quantitative easing in the face of another financial crisis, like, and it bails out all the, people who are taking risky stuff and like, going for the massive returns, and they all get bailed out at the cost of everyone else. It's like, it's going to be bad. Like, people are going to be furious, and hopefully it can waken people up to like the Federal Reserve. Maybe more people will start paying attention, but like this institution is just doing so much bad in our society right now.
Right. I think you really have to divorce the idea of the Fed's like omnipotence or like all-knowing nature from their actions. Like, you have to just look at the motives. You have to just think really hard. Okay, the coronavirus, right, is proposing this existential risk to financial safety. It's like, the rate cuts do nothing for that. You have to just start off of that. Rate cuts.
Wait, yeah. Let me just say one thing about this, because we haven't even brought up how absurd on its face it is to cut interest rates to fight coronavirus. Like, people, the reason the global economy is shrinking is because people aren't going out of their homes. They're just locking themselves up in their homes and doing nothing. They're not going to school. They're not going to work. That's why the economy is shrinking, because there's a virus. If you just even if you just printed the money and handed it to people, like some governments have done, I think Hong Kong did this.
Hong Kong's trying it.
Yeah, they just gave everyone 10 grand. Guess what people still aren't doing? Going outside, going to work. So giving people 10 grand doesn't do anything. Doesn't cure the virus. It doesn't stop. It literally does not do anything. All that money is going to do is when the virus is like no longer an issue, then people are going to go out and spend it. But guess what? They haven't been making anything while the virus is going around. So you're just going to have a huge spike in inflation as soon as people get out and huge shortages. So it's like, it literally does nothing to alleviate the problem. So like, I feel like we should have started with that earlier, but it's like, this rate cut, these monetary policies going to do nothing in the face of a virus. Like, that's like, what the heck is that going to do to solve that problem?
Yeah. So call that futile. I really think you should. I think it's reasonable to say like, there's no way a rate cut would measurably help any actors trying to fight the virus, anybody affected by the virus, anybody. Cheap money is not helping anybody involved.
Right. Yeah.
Cheap money helps.
So there's no one out there who's like working on a virus, but they're like, crap, my interest rates were just 0.5 too high. Right. If only they were 0.5 lower, I would be able to have a vaccine ready to go and virus cured. Like, that doesn't exist. That's not That's not
Yeah,
what's
it's not.
happening.
What it may do, well, a lower interest rate will force people with, say, a high yield savings or some kind of savings that's linked to short term lending, short term risk free lending. They're yielding less from their savings.
Yeah.
So it's forcing those savings into the stock market.
Yeah.
So that leads me to my second point, which is the only other motivation is what have we seen? A 12% drop in the stock market
Right.
at the time of their decision making for this emergency rate cut. So it's just like they are so So you kind of mentioned, is there a reason why they want the market to always go up? I think certainly there is. I'm not going to, maybe in another episode or later on we can speculate all the reasons. I think there's a lot of reasons why they want the stock market to keep going up. Just kind of financial stability you can point to. But I think that's their lone acting point. That's what they're acting on. The stock market going down, we have to cut rates. The coronavirus has made the stock market go down. We want the stock market to go back up, which is, I can't stress this enough, this is not what they're supposed to be doing. This does not help the people that they are supposed to be helping. This does not help the financial system that they're supposed to be maintaining the safety and security of. It's just, I think it's just this blatant, I think this week is the blatant end of the debate. It's like, what are they acting upon? Are they acting upon, good reasons, good economic driven philosophy, policy? It's like this week ends that debate in my mind.
Yeah.
I've always thought that that's what they act upon, the stock market, and here it is. Here's the proof this week.
Yeah, I think that's true.
On a silver platter.
I think this really does end the debate. Is like you cannot point to, like the last rate cut they did was suspicious. It followed like a 10% drop in the stock market. This one is like, it's so obvious. It's just so obvious at this point. It's so like obvious. There's really, so if you go, oh, what does the Federal Reserve do? Oh, they prop up the stock market. That's what they do. Like that's it. That's their purpose. Go. We just got to redefine what it is. And it's like, all right, there's just this thing that exists that's going to steal money from you to prop up the stock market. So it's like, okay, what do you do in the face of that? Well, the obvious thing is to put money into stocks, but I think there are risks to that, unfortunately. But just knowing that, their intention is to make stocks go up, it's just like, well, it gives some merit to putting your money into stocks but the question is we don't know how far they'll go to keep it propped up. Like if they'll go to any length, then put all your money in stocks. But there's probably a limit, so I wouldn't say that's necessarily.
Well, I wouldn't say that. I would say before the realistic limit of how much they can make the stock market go up comes into play. I think the more prescient question is how much does the stock market go up actually? How much real yield is there?
In real terms. That's true. So, because if the Fed is starting to really just create lots of inflation to prop the stock market up, at some point they may actually be the stock market may actually be going down in real terms.
Right. So the perfect example of this again is, did he start with Argentina? Did he mention? Or
I mentioned Argentina just a little bit.
Yeah, Argentina with a 60% inflation rate. Oh no, I'm sorry. This is Venezuela. It's a similar case though.
Venezuela's the worst.
Yeah, Venezuela's inflation is like 200% or something.
They had like 2 million% inflation.
2 million%.
In 1 year. It was obscene.
I mean, the stock market was up like 2,000%. And so you say, oh, 2,000% return on stock market. That's, I'm interested. But if you put the money in and then you take the money out and you've yielded 2,000% return, but meanwhile the cost of bread has gone up 2 million%. you've lost a lot of money. You lost
You lost a
your
lot of
money
bread.
yeah, right. You lost a lot of purchasing power. Exactly. So you've so that's the real question that the Fed's either not asking or they're comfortable that it's not happening because their quote unquote inflation is low. But it's not looking good.
Yeah, and they also act like stagflation is impossible. They
Yeah.
even though like it's happened before, they just act like that's not it can't happen. But it's like I don't know. I think that's a very realistic possibility as we enter recession and the money supply is just increasing so much that we actually start to have stagflation.
Yeah.
Stagflation meaning like recession and inflation at the same time. And that's like the most miserable thing that can happen is those two things, right? So like at least in the Great Depression, when you like, the economy was shrinking, the price of goods was going down as well. So your purchasing power was increasing. So like your savings were getting you more and more stuff the deeper you went into the depression. So like that at least was like a saving grace. But if you're laid off and then your money's rapidly losing purchasing power, that's a hell of a situation to be in. It's like you have nothing to fall back on. It's just a disaster case.
Yeah, that is the worst. I've talked about this before on my Twitter. So let me just take a moment to say follow JRchi14 is my Twitter, and Jeff's Twitter is at Do Less Podcast. He's our social media correspondent. But I've talked about this on my Twitter how purchasing gold is a good inflation hedge. So gold has a lot of properties. We'll do an episode someday about gold and why it's kind of magical. It's kind of this like mysterious element. And if you buy gold, it tends to do well against inflation. It tends to, I mean, the element itself, the rock itself, isn't changing, so it's hard to like say that it's like it doesn't diminish. It doesn't increase in value, but it doesn't decrease in value in any way.
Right.
The properties that you can buy it, the properties it will offer you if you buy it today will remain if you buy it, if you sell it in 10 years. So however much gold the dollar was able to buy in the past, it should be that same amount of gold should be kind of linked to whatever that amount of purchasing power from that dollar you were able to get in the past in the future. So I think gold is a good inflation hedge.
Yeah, I mean, so gold is a great inflation hedge against like the dollar, but gold itself can be thought of as money. And so like the supply of gold does change over time. That I think is actually the less significant thing. But like if the supply of like goods and services drops, but the supply of gold likely will not, then there's not only inflation in the dollar, but there's also inflation in gold because there's the same amount of gold, but just fewer goods and services out there. So you probably still will lose some purchasing power if there's like a deep recession, even if you hold gold. But you're going to lose a lot less purchasing power than perhaps the currency if it's being inflated at a rapid pace, like we suspect it will be by the Federal Reserve. So it's not to say like, gold is just like this perfect investment and it's just like put all your wealth in gold. It's like, no, it's flawed. There's reasons not to do that, but it's I don't know. It's pretty amazing element at the end of the day. And it's like, it's always going to have like a floor value that it's never going to drop below. Cause it's just like, I don't know. It's just, it's just
so high in demand.
Right.
Yeah. It's always been interesting to me my whole life, whenever I've learned about personal finance and investing, It's always there's always been a recommendation to 5%, 2 to 5% of your net worth allocated to gold, and I'm just like, that's something.
Right.
And then now I realize I'm like, there's a reason for that. It's not going away as a investment, as a hedge for inflation, which is a super powerful force in an economy, as we will see coming up in the future. So there.
I think that's a good place to wrap up.
Cool.
Hopefully the Fed does less stock watching.
Yeah.
Does
the Powell
more.
put.
Yeah.
The Powell's super put. The leveraged Powell put.
Basically, stonks only go up, so just buy S&P calls and you're guaranteed to make money.
And sell puts.
Yeah, sell puts.
No, just kidding.
Just free profit.
Nothing we've said this episode is investment advice.
Yeah.
Do your
I
own
don't know what
research.
the legal disclaimer is, but please don't sue us.